What is the Fed interest rate hike, and what does it mean for you? Stay tuned. Today I speak with Lysa Catlin from Caliber Home Loans about this and more. You're listening to the Close to Home podcast, the lifestyle and real estate podcast centered in Seattle. I'm Brennan Klaus, and I'm a broker at Avenue Properties. Hello and welcome to the Close to Home podcast. I'm so excited today to have Lysa Catlin on. How are you?
I am well, thank you, and so excited to be on today.
Yeah, so happy you're here. We have some pressing news we're going to talk about today, which should be really fun.
We do.
But I'd love to start with just a little bit about yourself, and you're a mortgage lender, or
yes.
Should we formally call you a loan officer?
That works too. I answer to all titles.
Okay. So we'd love to know, how you got into lending and what you're doing today and what your background is.
Sure, absolutely. I actually grew up in lending. I am a second generation mortgage originator. My mother owned a mortgage brokerage firm in California for years and years and years. Of course, I swore I would never get into lending. Did a brief stint as a biochemist and now have been originating for 23 years and absolutely love it.
That's awesome. And so you did biochemistry before?
I did.
Wow. Does any of that help today in what you do?
I think in that I'm very organized and I'm analytical.
Yeah.
So I think that does carry over.
Yeah, absolutely. And 23 years, so you must have seen a lot go on.
Oh my gosh, yes. I remember in 1996, I was so excited that interest rates had hit 7.5% at 2 points that I printed it on hot pink flyer paper and handed it out to anyone who would take it.
Were you just out on the street handing it out?
Yeah, actually California does a broker caravan, they called it. So before a property could be on tour, the real estate agents from all the companies would showcase the home at a meeting, and so as a lender we would go. Interesting.
That's awesome. So you were there with your hot pink paper.
I was.
That's amazing.
Pitching 7.5% at 2 points happily.
That is so great. Well, I'm super happy to have you here today, and the topic we're going to talk about, which just came out in the news, is the Fed rate hike.
Yes.
For interest rates, and we're going to talk a little bit about how that impacts people in today's market.
Absolutely.
So I would just like to start basically, what does the hike in interest rates from the federal government mean?
Well, it's interesting because the Federal Reserve changes the Fed's fund rate, and that's really an overnight bank-to-bank rate. It's the rate at which banks lend other banks excess reserves just for overnight. So it's a short-term lending rate. It doesn't impact long-term rates directly, but there's always a ripple effect in the economy, and that can take a while to be seen. It affects things like credit cards, home equity lines, car loans, but not necessarily mortgage rates, at least not directly.
Okay, got it. So it's an overnight rate. So just the rate that they're lending overnight, so the interest of the night.
Exactly. So what happens at the end of the day, commercial banks have to keep a certain amount of reserves at the federal banks. If they're short reserves, they borrow the funds that they're lacking from another bank. And what they pay that other bank for those funds is the Fed's fund rate. So it's a very short-term overnight bank-to-bank lending rate.
Okay, got it. And does it affect things like you mentioned, like home equity lines of credit, credit card debt? Does it affect those more directly than something like a mortgage rate?
It affects those short-term, more consumer debt. It does. That affects that pretty much immediately. It does increase the cost of money overall, which will trickle into the economy and, decrease the money supply, and does affect long-term rates, but not quite as quickly as people think.
Okay.
And what you see is the market reaction. So right after the Feds made their announcement last Wednesday, the interest rate hike was somewhat priced in. We were all expecting that.
Okay.
What really made the markets, I like to use the word jumpy, not very technical, but people reacted to their policy statement because the Fed actually changed their outlook on the economy to rising at a moderate rate to rising at a solid rate. And analysts took their statement to mean it's likely we're going to see 2 more interest rate hikes before the end of the year.
Right.
That would make a total of 4 for 2018, and that we might see 3 in 2019. So when you saw interest rates sort of bump up, it was more the reaction to the commentary than to what actually happened that day.
Got it. And when you talk about the interest rates that bumped up, you mean the home mortgage interest rates.
Yeah.
Got it. Yeah, because I was going to bring up, so this is important because this is the second of potentially 4 interest rate hikes that will happen this year.
Correct.
So you said that the reaction was jumpy to, this outlook on the economy, which went from moderate to
rising at a solid rate.
So
what that means is that the Fed is saying the economy is doing better than we thought. And because it's doing well, that leaves us room to raise interest rates more quickly. That helps stave off inflation, and it contracts this, a heated economy.
Got it. Okay, so it's actually because our economy is doing well.
Yes.
And then there could potentially be 2 more this year in 2018, and then potentially 3 in 2019. So we already saw a little bit of that in the home mortgage interest rate, is what I'm hearing you say. How else will we see that in home mortgage interest rates? Will we see more of that?
I think that's a mixed question because there's so many different factors. Again, the Fed's fund rate is a short-term lending rate, so you're going to see short-term rates on credit cards and home equity lines. That's going to change right away. But there's more factors that go into mortgage rates than just the Fed funds rate. For example, rates have actually come down a little bit this week from last week. We're seeing a bit of a flight to quality into the relative safety of U.S. government debt, and that has to do with the potential fears of a potential trade war with China. So that's kind of pushing interest rates back down, and I think what happens with the economy, it's really much more of a global economy than it has ever been.
Yeah.
And so you're going to see some tug and pull in interest rates. We have seen rates come up. They've come up almost a full % since December of last year. A 1% rise in interest rate lowers a buyer's purchasing power by just over 10%.
Wow.
It's amazing.
Yeah.
So, if you were shopping for a home around $750,000 in December of last year, if you wanted your house payment to stay the same with today's interest rates, you'd want to shop around $675,000 to keep that payment the same. It's pretty significant.
Yeah, absolutely. So just to repeat what you said, each point of interest, so 1% of interest, is equivalent to 10% in purchase price?
Purchase power, exactly. So a 1% rise in interest rate lowers a buyer's potential purchasing power by approximately 10%. It's just over, actually.
Wow, interesting. So essentially, and what we know in the business is that the longer you wait, if the interest rate is rising, the less purchasing power you may have.
Yes, and of course, that's complicated by the rising home prices as well. So waiting, at least, recently has not worked in your favor. You've got rising interest rates and rising home prices.
Yeah, absolutely. So how else should we expect this announcement to impact home buyers?
I don't think it's going to impact them, at least right now, that much.
Okay.
If you look historically at interest rates, the average interest rate from 1980 to 2006 was 8.1%. Right now, according to the Mortgage Bankers Association, the average 30-year fixed mortgage is hovering around 4.83%.
Okay.
So we've come up, yes, but historically we're still really low. And locking in on a 30-year fixed mortgage is the best way to inflation-proof your house payment.
Got it. And do you think that will change with 2 more announcements of a Fed rate increase, or will buyers still be sort of okay for this year?
I think they're going to be okay. And I've been asked the question, are you worried? You've been originating for a long time. You've seen cycles in the market. Are you worried? And I'm really not. It's interesting when you look at the economic forecast in what I consider the big 3.
Okay.
And for me, that would be Freddie Mac, Fannie Mae, and the Mortgage Bankers Association. They publish economic and housing forecast. And I took a look at what they had just recently published.
Yeah, tell us
Freddie
about
Mac is predicting that we will be at 4.6% for a conforming 30-year fixed mortgage by the end of the year,
that. Okay.
and only 5.1% by the end of 2019. Fannie Mae is predicting 4.6% by the end of 18 and 4.6% to remain steady throughout 2019.
Oh, interesting.
Now, Mortgage Bankers Association, they're just a little bit higher. They're predicting 4.9% by the end of 2018 and 5.3% for 2019.
Okay.
Question for you.
Yeah.
Can you guess who historically is the most accurate?
Oh my gosh. The one in the middle, Freddie Mac.
Oh! No, Fannie Mae
Fannie
was the
Mae.
one.
Oh,
You
darn
did
it.
get the middle right, though, yeah.
So the 5.1 over 2019.
Yeah, they're actually predicting 4.6.
Oh, they're predicting 4.6.
So Fannie Mae
Okay.
historically has the best interest rate forecasting history, and they're predicting 4.6% by the end of this year, which is slightly below current levels,
Yeah.
and that will remain steady through 2019.
Interesting. Okay. And so it sounds a little bit like this announcement of the Fed rate hike is more about the stir and camaraderie around announcing it in terms of home lending versus the actual impact that it will have.
Well, yes, I don't disagree with that. It's going to have an impact. It can't not have an impact
Right.
because the cost of money will be affected, and
Yeah.
that will filter its way through the economy. The effects of raising the Fed's fund rate can take up to 12 months to be seen, but I think the important takeaway is we're starting to flatten out. Rates
Okay.
have come up. They're higher than they were a year ago, but historically they are still very, very low. Great opportunities to lock in on a low fixed rate mortgage and inflation-proof your house payment. But I think it's unlikely we're going to race away from current levels.
Got it.
You
We're
know,
not going to see like 7% in the
8%,
next year.
no.
Yeah.
I think that's very unlikely.
Okay.
I will tell you my personal opinion is I think we're going to be in the low fives. I would love to be wrong. I hope Fannie Mae is right and we are going to stay at 4.6% all the way through the end of 19. But I think if we stay in the high fours, low fives, that's still a tremendous gift and gives a lot of opportunity for people who haven't yet had a chance to buy a home to go get into the market
Absolutely.
and secure a
Absolutely.
nice mortgage.
Because what's the average rate over history? Is the average?
It's 8.1% for 30-year fixed from 1980 to 2006. So
Okay.
26 years.
Yeah.
So we have some room.
Yeah, we have a lot of room. That is a nice gift, as you put it. So one last, maybe sort of curveball for you. It wasn't on the script, but what is buying down an interest rate like for home buyers? And do you think more people will start to do that because we've been used to these sort of like 3 and 4% interest rates for the past few years?
I think that's a great question, and the answer is not one size fits all. When you lock a mortgage rate, you are essentially taking a picture or a snapshot of the market at that moment in time, and pricing's a grid. This interest rate, this closing cost. This interest rate, a little bit higher closing cost. Very roughly speaking, for every half point additional you pay in closing, and a half point again is a 0.5% of the loan amount, you will lower your interest rate by roughly 0.1%.
Okay.
Now, there is sort of what I call a sweet spot within that curve, meaning that works to a point, and then at some point you're paying 2 or 3 points to move the needle, and it's not worth it. But to answer your more specific question of will more buyers be paying points, it's just math, and math doesn't lie, which is why I love originating. It's a very simple calculation that your mortgage originator should be able to walk you through. How much more are you spending at closing to buy that interest rate down? How much does that lower your monthly payment? And how many months do you have to hold the mortgage to make up for that upfront investment?
Got it.
Generally speaking, given the time value of money and inflation, you want to see that payback in 48 months or less.
Okay.
If it's going to take more than 48 months to gain back the upfront closing costs that you're paying, you're typically better off just applying those extra funds towards the mortgage balance.
Got it. So just putting more down as opposed to paying that as points.
Exactly.
Got it. Okay.
The other thing I think it's an important conversation to have with your lender is how long are you going to stay in the home? Is this your home that you are going to own forever and ever and ever? Or do you see yourself in a transitionary period and this home's only yours for 4 or 5 years?
Right, because that will change the type of loan and how much you're planning to pay down or pay towards your interest rate.
Absolutely.
Okay, got it. And to back up just a little bit, could you repeat those 3 questions again? That if a buyer is thinking about paying points towards their interest rate, they should ask their mortgage lender?
They want to ask their mortgage lender how much additionally does it cost up front, how much does it save them on a monthly basis, and how long is that going to take to make up that upfront investment back?
Got it. And then the kind of rule of thumb that you mentioned is that it should take 48 months or less to make up that initial investment.
That's an ideal situation.
Okay.
Now, again, if you find your dream home and you're going to raise your family and your grandchildren there and you want to pay points to make the interest rate as low as possible, absolutely go for it.
Yeah.
But for most people, you want to see that upfront investment pay back within about 48 months.
Got it. And like you said, not one size fits all.
Yes, absolutely.
So anything else that we should think about or know about in terms of the Fed interest rate hike?
I think pay attention. I think it's all subject to change.
Okay.
And so right now we're feeling a little bit optimistic that rates are going to flatten out, but if anything dramatic happens in the economy, you could see a shift.
Mm-hmm.
My personal opinion is you need a place to live, rents are rising, so waiting probably isn't the best thing to do in terms of interest rate and getting in, locking on a low 30-year fixed mortgage and set yourself up.
Got it. Okay, great. And so on to my last question for you, which I ask every guest. What, Lysa, is your favorite room in your house and why?
It's so funny to hear that question because I had to think about it, and I'm going to have to say the kitchen, which anyone who knows me will think is incredibly ironic because I truly dislike cooking, and my husband does most of the cooking.
Same here. No cooking club.
But it's the place that everybody congregates. We have a great room-style kitchen, and we do family dinners most nights of the week, and that's where the best conversations and the best laughs happen.
Absolutely, yeah. Do you have like you say great room kitchen, so people can kind of sit down and cozy up and chat and learn about each other and watch people cook? Watch my husband cook
and me do dishes.
That seems like an equal trade-off.
We try.
That's how my parents did it. Great. Well, thanks so much for being here, and I'd love for you to share with the audience how they can reach you if they have any additional questions.
Absolutely. You can give us a call anytime, 206-963-0191, or look us up online at lysacatlin.com, and I'll spell that for you. It's LYSACATLIN.com.
Awesome. Well, thank you so much for being here. I really appreciate it and giving us the 411 on the Fed interest rate hike.
Thank you for having me.
Thanks for listening to the Close to Home podcast. Be sure to rate and review us on Apple or wherever you find this podcast. If you'd like to contact me, Brennan Klaus, about any of your real estate needs, you can find me at 206-899-9101 or at brennenklaus.com. That's BRENNENCLOUSE.com.